We are thrilled to have with us today the Managing Director and World Bank Group Chief Financial Officer, Joachim Levy, the wonderful Sonia Gibbs, whose work on capital flows we are all following, and who is Senior Director of Global Capital Markets at the IIF, will be asking the questions, and I ask you to please join me in welcoming them.
Joaquin, thank you so much for joining us. It's such a busy week, making time in your schedule. So just to sort of pick up on some of the themes that we've been talking about in the previous sessions, I wanted to start by getting your thoughts on recent market developments. With central banks pursuing policy normalization, escalation in trade tensions, capital flows to emerging markets have really been suffering. How do you see the situation, and how can policymakers in emerging markets cope with this? What are the best strategies?
Well, first, it's a pleasure to be here. And that's been a great week. I think that much has been achieved in terms of development, awareness, and I think also in terms of sustainability, discussion sustainability, and this is all important when you look at the long run. Now, when you look at the short run, which you asked, I think that we do have some headwinds, and I think in addition to what you mentioned, there's some concern in some places because of large debt, public as well as corporate debt, and I would say that in terms of response, we could think about three aspects. First, I think that we have to think about resilience, and we could think preparedness first. And there, I think some countries are still doing well, and they're trying to reinforce their position. And even those who are not doing that well, but have something in their favor, they're also trying to address that. I think, for instance, India is resilient. The currency has changed. Of course, it's a source of concern, but there are a lot of good things going on, and as long as they continue this path, and also they also responded. For instance, changing the taxation of local currency, global bonds, and things like this. I could think also about Indonesia, with also taking measures. In a way, even Brazil, which the currency has fluctuated quite a lot, but the current account is pretty solid. I mean, it's a deficit of less than 1%. It's on the reserves, and a situation that is quite, I'd say, prepared to take shocks. And then I think that there is those who have to deal with a crisis response. And they are ranged from Turkey, I think Argentina, and other countries that are trying to act as they're in the midst of a crisis, and they realize the vulnerability. Sometimes you have more room, sometimes you have less. And in both cases, I think sometimes what is positive is that when there is possibility, people are using the IMF to help. I think in the case of Argentina, better to do it now. There is a political cost than to postpone and then to do in a worse condition. There are countries that I put perhaps in the preparedness, think about Egypt, but a very steady program with IMF. And then I think what is important is in all these situations to think about resilience, which is don't forget the long term. And I think if I come back again to Argentina, there is an effort that as the adjustments are made, you protect the poorest, you protect the education, so on. So, for instance, when the World Bank brought support, was for very special programs, and basically programs looking at the social protection. So you can make the adjustment. You have to make some tough adjustment in the fiscal, but you target to protect certain areas. I think that's really in terms of say, the actions that governments can take, in addition to respond with monetary policy, which is a short-term lever. I think that looking at where your vulnerabilities are and start to develop a strategy to address looking at the social impact and trying to protect that, as well as to continue to preserve a minimum of long-term investment. I think it's really what we try to achieve in our conversation with countries. But no doubt that in the short term, we're going to see a continuous headwind. But as was mentioned before, when you look beyond that, I think that the proposition of emerging markets continue to be extremely attractive.
And perhaps relative to 20 years ago and the Asian debt crisis, the backdrop is a little more resilient, perhaps.
Oh yes, no doubt about this. And to say, if you were to talk about Latin America, for instance, I think it's quite noteworthy that they have suffered, most of the countries have suffered quite a large shock with commodity prices. And the responses, I would say, are mostly responsible. And in some cases, they even have coupled to the commodity prices a political crisis. And still, you don't see, except very exceptional cases, a response that will not be textbook. I would say that, I mean, I'm perhaps biased, but when you look at Latin America and other countries or other regions, I would say that the response of Latin America in most cases has been very prudent and I would say balanced in terms of the macro response.
And maybe you can outline a few specific cases that you see as particularly positive or negative in terms of their response.
Well, look,
region.
think about Peru again. Combination of a commodity crisis and political crisis, and still it's reasonable if you think about the policy mix. If you think, of course, there is Chile that is doing it well. Mexico so far. It's a different situation, but has also its own share of shocks related to trade, etc. It's going. I mean, we're going to get a new government, but so far the message has also been a message of discipline. Even in Brazil, I mean, there's polarization in terms of perhaps political, but there is no real demand for, say, just let's spend a lot or let's have a very loose monetary policy. There's no appetite among electorates for that.
But maybe just to follow up on a couple of the points that Deputy Secretary Herrera made in the last panel, in terms of the impact of the NAFTA negotiation and also sort of trade tensions more broadly, how do you see that playing out in Latin America?
Well, I think that I would say that it's a composition of factors, and it was also mentioned before here. Of course, we are in a moment where, for instance, tax reform in the U.S. and tax cut in the U.S. It affects directly, indirectly. First, of course, the change in corporate tax and so on changes the incentive. For investing abroad, gives more, say, certainty to invest in the U.S. But on the other hand, also we have the domestic demand impact, which is by increasing the demand here, you appreciate the dollar, and to the extent that this changes the mind of people in the short run about capital flows, it does have an impact on countries. So I think the trade for some of the Latin American countries is not, of course, as central as with Mexico. Some countries like Brazil actually have a trade deficit with the U.S. But I think the other factors are very important. Actually, I mean, it's not a surprise as or something that new, but we know that trade is not driven mainly by tariffs or things like this, but actually by macroeconomics. We know that the U.S. deficit is driven a lot by other policies and not because you have or you don't have a tariff. So this is also, I think, true for Latin America.
Yeah. Well, maybe let's focus on Brazil for a minute. Obviously, we understand you can't comment on politics or the elections, but maybe you can talk a little bit about how you see the economic prospects and challenges, such a strong economy, yet room for improvement in many areas, perhaps.
Yeah, I think that I mean Brazil is interesting because, for instance, if you think about exports, the composition of exports of Brazil is not that different. For instance, the composition of Australia, mostly say commodities. Australia is more in metals and energy. We are proportionally more in agriculture, but still, it's clearly this. So Australia has a bit more, and they talk about this quite a lot, which is important. They have in the part of services, education. It's increasingly an important part of their trade in a way. But so. I would say that in Brazil, we have to be aware that, for instance, studies of the World Bank show that the expectation of commodity prices are of stability, stagnation. We're not going to have another boom. So that, of course, means a persistent situation of that you have to think about other drivers of growth, even if you continue to increase the productivity in this sector. The service sector in Brazil is very dynamic. And you mentioned that I should not talk about politics, which is true. I would just comment that if you want growth in Brazil, I think the uncertainty and the political uncertainty is the main thing. I mean, even if you look a few years back, it was the doubt that you could pass some reforms that are not the most complicated reforms possible. Pieces, parts of these reforms have already been approved. But if you could turn the page, clear that, I think this will give confidence for investment. And if you see the difference in, say, the decline of GDP 5 years to now, most of this decline is actually the reduction of investment. So, okay, part of this investment was driven by the government, maybe a little bit artificial, but part was also because of confidence. You have to recover that. You can get 1 or 2% of GDP just by doing this, and this will create a positive scenario. But you need the confidence. Let me say also one thing, and this is true for the whole Latin America, especially as we talk about the stability of commodity prices, which is we have to focus more and more on human capital. And we are the bank, we are really making a big case of that. Now, when you go to Bali, one of the main things they're going to do is to launch what we call the Human Capital Index, which is a little bit of like you have a doing business index, but you would have a sort of a ranking of countries in terms of what is their human capital, which is basically the expectation if you're a young person, the expectation of how much, on average, you would have of human capital and what they would imply for your capacity to generate earnings along your life. And we know that, especially in more developed economies, and more, human capital will be more important than physical capital. The same way that most of the value of companies nowadays is in intangibles rather than tangible. So this is a natural a path for economies. So I think that as you look forward, and I don't know how you guys, when you do your investment analysis, especially for a little bit longer period, how much you factor in of the increase in human capital. But if you are thinking in growth over 10, 20 years, no doubt that will be more and more the most important component.
Well, maybe an underlying theme here and a topic that I know is very close to your heart in terms of improving human capital, ease of doing business, and so on. But infrastructure investment, right? So across emerging and frontier markets, clearly this is a super important factor, and the World Bank has made tremendous strides, the Global Infrastructure Facility, and promoting more private capital into infrastructure. So maybe tell us a bit about some of this progress in Latin America and elsewhere in emerging and frontier markets.
Let me first talk about, something that's behind our vision there. If you look in the last few years, the remuneration of capital, even if now you have normalization of interest rates, etc., has dropped quite dramatically. In a way, you could say that capital, again, tied to physical, to tangible things, is not the most constrained thing over the globe. And the remuneration has dropped. There is some of you may probably have read some of the papers that were presented in Jackson Hole last month, and there is a whole discussion about how the structure of economies, say the U.S. and others, have changed. And like I said, a lot of it's intangible capital versus tangible capital. Now, if you are an asset manager, that is a big thing. And so what is really profitable is to have the control of companies, or if you have something that can provide you some monopoly power, intellectual property, and things like this. Capital per se is not finding that much return in economies like the U.S., even if the government helps. And I think that will continue the more and more the economy becomes virtual. So I think one of the important aspects of infrastructure, especially in emerging markets, is that, well, this is where you still have a bona fide long-term demand for capital. And these are the kind of things that you can invest and expect if the conditions are right. And I can use the remaining few minutes to talk about this. If the conditions are right, it's the kind of thing that can bring you a steady long-term return. So our work is really by looking at this situation. There is a demand reflecting in long-term interest rates that are still low, etc. Where we can find a good source of demand of capital that you have long-term returns. Infrastructure is the right thing. And also it has a lot of other benefits. So you remember at the beginning I was talking about sustainability. Well, if these countries are to grow, we better invest in climate-friendly, climate-smart infrastructure. So our challenge is how to help the origination, to create new projects so that people can find possibilities, especially the fixed income. There is a space for equity, but we cannot finance infrastructure only on equity. Now, fixed income means fixed income, and sometimes in emerging markets, things are not that fixed. So we have to help fix what is supposed to be fixed. If you allow me, I think I'm lost in so many words. But anyway, our role there is really to stimulate first the reduction of the risk of the project by better policies, better design, etc., including adaptability, long-term resilience, etc., because what we decide to build today will be completed in 5 years and has to last another 30 years. Well, throughout this period, you're going to have climate change one sort of another, so you better factor this in when you do the project now. And in addition, also to use our balance sheet, and probably many of you have heard that before, but use our balance sheet to take some of the risks that are not compatible with the risk capacity of institutional investors. Now, we all hear about the trillions of dollars that are idle and so on, but this is not necessarily high-risk capital. So you have to make this merge between what kind of risk we can take, and our remuneration is different because, of course, we are a public institution, ultimately is a public multilateral banks, and then the funding that is necessary. And this also is what will make the infrastructure affordable, because like I mentioned, if you have on equity or you have a very high risk premium, we get on something that is not economically sound, and we don't want white elephants. We want infrastructure that are resilient, that really help transform the productivity in these countries, because the thing about infrastructure is that you think about many countries in Africa or in other regions, and it's very hard to compete in trade and do everything to sustain the growth of the middle class if you don't have a minimum of infrastructure. So these things are linked, and they bring both social sustainability and I would say also stability in terms of migration, in terms of this type of pressure, which is very important also to address because it has global repercussion, as well as providing a long-term steady, usually uncorrelated source of income that I think fits the pattern or the needs for institutional investors, including insurance companies.
And I think there are a lot of people jotting down notes and listening to that. So I hope that you can stay with us for the reception tonight because there'll be lots of questions, I'm sure. But thank you so much for sharing your insights.
Thank you very much
helpful.
for having us.
Thank you.